Welcome to the Deep Dive. We're the place you turn to for, well, the essential insights without all the surrounding noise.
And today we've got something pretty interesting. We're digging into a 2015 shareholder letter from a major global bank.
Right, and this isn't just your standard financial report. It's more like a strategic blueprint.
Exactly. It shows how they were thinking about safety, navigating this really complex post-crisis regulatory world, and also facing up to tech disruption.
So our mission here, what we're trying to figure out, is how they balanced being, quote, safe and strong, building this fortress idea while still chasing profits.
Yeah, record profits, in fact, but in an environment basically designed to hold them back, a real balancing act.
Okay, so maybe let's start with the headline numbers, just for context.
Good idea. So 2015 on the surface looked fantastic, a record $24.4 billion in net income.
Huge number. And revenue was what, 96.6 billion now?
Yeah, massive figures. But like you hinted, that's not the whole story. It never really is with banks, is it?
No. So where's the catch? What's the tension here?
It jumps right out when you look at the key metric for shareholders. Return on tangible common equity, or ROTCE.
ROTCE. Okay.
Despite those record profits, ROTCE was actually, well, kind of disappointing to them.
Yep.
It came in at 13%.
Okay, help us unpack that. I mean, for anyone listening who isn't buried in bank reports all day, why is 13% ROTCE seen as disappointing when you're making billions?
Right. It's because the goalpost had moved, fundamentally. After the crisis, new rules forced banks like this one to hold way more capital against their assets.
More capital held means?
It means the E and the RTCE, the equity part, the denominator in that calculation, gets much bigger. So even with high profits, the return percentage drops.
Okay.
And management was really clear about it in the letter. They said the lower ROTCE was down to three main things.
Which were?
One, much higher capital requirements. Two, the really staggering cost of controls and compliance. And three, interest rates were stuck near zero, which hurts bank earnings.
So they were safer, no doubt, but that safety came with a hefty price tag.
Exactly. Safety was expensive, which means the letter wasn't really a victory lap.
No, it sounds more like, here's our strategy for surviving and thriving in this new, tough world.
Precisely. And that brings us neatly to the first big theme, this idea of the fortress balance sheet.
Okay, fortress balance sheet. What does that actually mean in practical terms? You know, for someone maybe worried about another 2008.
It means they seriously beefed up their financial defenses. You can see it clearly in their main safety metric, the Common Equity Tier 1 ratio, CET1.
CET1, right?
Right.
That measures the core capital buffer against losses.
Exactly. And that ratio went from 7.0% back in 2007 under the old, less strict Basel I rules, all the way up to 11.6% by 2015.
Okay, 11.6% under the new, much tougher Basel III rules.
Correct. So a significantly bigger cushion. And if you look at the actual dollars, the tangible common equity.
It's the hard cash they could use to absorb a hit.
Pretty much, yeah. That more than doubled. It jumped from $74 billion in 2007 to $176 billion in 2015.
Wow, okay, so they really were stacking up the bricks for that fortress wall.
$1 at a time. But, you know, the real test of any fortress isn't how high the walls are, it's how it holds up under attack.
Which leads us to the stress tests, the Fed's annual CCRR tests.
Right. And the scenario described in the letter for that year's test, it was, well, it was designed to be utterly catastrophic. Pure economic collapse, hypothetically speaking.
How bad are we talking?
We're talking unemployment rocketing to 10.1%, housing prices crashing by 25%, stock markets plummeting, down almost 60%.
Oof.
And crucially, they layered on top an instantaneous global market shock that was even worse than what happened in late 2008, early 2009.
So conditions the bank itself probably thought were pretty unlikely.
They explicitly said they didn't think it was likely, but that wasn't the point. The point was proving they could survive even that.
And could they, under that nightmare scenario, what was the projected damage?
The projection was a loss of $55 billion pre-tax over the 9 quarters the test covered.
$55 billion loss.
Wow.
Sounds enormous.
It is enormous. But here's the critical context the letter provides, and this is key. They had around $350 billion in total loss-absorbing resources available.
Okay. So lose $55 billion.
And they could absorb it and keep operating without skipping a beat. That was the whole point of the fortress.
And this is where the sheer scale of this institution just boggles the mind. There was a comparison in the letter, right, about their buffer size relative to the whole industry.
Yes, it's quite a stunning point. They stated that their loss-absorbing resources, just for JPMorgan Chase alone, were large enough to cover all the projected losses for all 31 of the largest U.S. banks combined under that same stress test.
All 31 banks. What was that total loss number again?
The total industry loss projected in the CCR test was $222 billion.
So JPMC alone had enough buffer to cover the entire system's hypothetical losses, according to that test.
Essentially, yes. Their capital fortress wasn't just about protecting themselves. It was implicitly about stabilizing the whole system. That's the level of resilience they built.
Okay, so that's the definition of safety they were aiming for.
Yeah.
But it must have cost a fortune to build and maintain that fortress.
Oh, absolutely. Which brings us right into our second section, the incredible cost of controls and compliance and how they had to operationally de-risk the business.
Right. Let's talk about those costs. How big are we talking?
Just breathtaking, really. Look at headcount. Since 2011, the number of staff working directly in controls, so think compliance, legal, AML, KYC folks, went from 24,000,
Which is already a lot.
up to 43,000 people.
Wow, an increase of nearly 20,000 people. Just focused on controls. That's like a small city's workforce.
It's huge. And then look at the money spent, the annual budget just for controls activities.
Yeah.
It exploded. Went from around $6 billion a year to roughly $9 billion a year by 2015.
$9 billion annually, just on compliance and controls.
Yep. To put that $9 billion in perspective for you, that's bigger than the entire yearly operating budget of many well-known global tech companies. Companies focus purely on innovation.
So a massive chunk of resource just dedicated to essentially making sure they didn't mess up according to the new rules.
That's a fair way to put it. And this intense focus on risk reduction wasn't just about spending more money. It meant actively stepping away from certain business lines.
De-risking, right?
Yeah.
What kinds of things did they exit?
It was quite surgical. They completely got out of some entire businesses like private equity, trading physical commodities, offering certain types of special mezzanine financing.
Things that carried maybe higher regulatory or legal risks.
Exactly, or political risk. On the consumer side, they simplified things dramatically, too.
Yeah.
Like in mortgage banking, they cut the number of different products they offered from 37 down to just 15.
Simplify, simplify, simplify. Seems like the mantra.
It had to be. And they even went further than just exiting business lines. They actively started, ending relationships with existing clients.
Okay, that sounds pretty extreme.
Yeah.
You mentioned something like 140,000 consumer clients. And others too. Why?
It really came down to the immense burden of anti-money laundering, AML, and Know Your Customer, KYC regulations.
Making sure you know who your clients are and where their money comes from.
Precisely. Verifying everything for every single client across millions of clients became incredibly resource-intensive, and the penalties for getting it wrong were potentially catastrophic.
So it was an operational risk calculation.
Basically, yes. Simplify the client base to make the AML KYC task manageable and reduce the risk of a massive regulatory fine or action. They chose stability, even if it meant sacrificing some profitable client relationships.
Okay, besides simplifying products and clients, they also had to manage their overall regulatory footprint, right? Specifically, that GSIB surcharge.
Ah, yes. The global systemically important bank surcharge. Basically an extra capital tax for being really big and interconnected.
Another cost of being a fortress, I guess.
Yeah.
So how did they try to manage or optimize that?
Well, this part of the letter details what seems like a, frankly, stunning operational achievement. Their goal was to reduce their GSIB risk score enough to lower the target capital surcharge from 4.5% down to an estimated 3.5%.
Just shaving off 1%. Doesn't sound like much, but I assume on their balance sheet, that's huge.
It translates to billions in required capital they wouldn't have to hold. So yeah, huge incentive.
Okay, so how did they actually do it? What did they change operationally?
Two main things highlighted in the letter really stand out. First, they actively reduced certain types of deposits, specifically non-operating deposits, by about $200 billion.
Through shedding certain kinds of large deposits. And the second?
The second one is just mind-boggling in scale. They reduced the notional value of the derivatives on their books by, wait for it, $15 trillion?
15.
Trillion.
With a T. That number is almost meaningless. It's so large. How do you even do that? How do you operationally unwind or restructure $15 trillion in derivatives?
Yeah, it's hard to wrap your head around. It would have required a massive multi-year effort across their trading desks, their legal teams, their technology platforms globally.
Were they just getting rid of the risk?
Not necessarily getting rid of the underlying economic risk they were hedging. It was more about changing how they managed and reported that risk. Maybe shifting to simpler hedging instruments or using clearinghouses more, or netting down internal trades things that resulted in a lower notional amount for regulatory calculations.
So a massive internal plumbing overhaul driven purely by the GSIB rules.
Pretty much. A huge systems and process reengineering project aimed at regulatory optimization.
That focus on, well, technology and efficiency really sets up our next section nicely. Section 3, innovation, tech, and how they were fighting back against, the fintech threat.
Right. They clearly recognized technology wasn't just a cost center anymore. It was the battlefield for the future of banking.
And they were putting serious money behind it.
Oh, yeah. Over $9 billion spent annually on technology back then. And importantly, they said about 30% of that, so nearly $3 billion a year, was dedicated specifically to new investments, not just keeping the lights on.
And the people power behind that.
Also massive. Over 40,000 technologists working for the bank. They were essentially a giant tech company inside a bank.
So they weren't just sitting ducks waiting for Silicon Valley to eat their lunch, especially in a critical area like payments.
Definitely not. They had a very specific strategy they called the trifecta to compete in payments.
Okay, the trifecta. Let's break down those 3 parts.
Sure. It was about controlling the whole payment flow. Prong 1 was Chase Payment Tech. That's the merchant processing side, handling the transaction for the retailer, the back end.
Got it. Prong 2.
Prong 2 was ChaseNet. This was clever. It was basically a partnership using Visa's network, but allowing Chase to offer merchants potentially better pricing and, maybe more importantly, richer data insights on transactions.
Adding value beyond just processing.
Prong 3 was Chase Pay. That was their consumer-facing digital wallet, aiming to get customers to use their app or card online and in stores, and they highlighted key partnerships, like with Starbucks, to drive adoption.
So covering the merchant, the network, and the consumer. A full stack approach.
Exactly. Build a defensive moat around their payments business.
And they didn't ignore the rise of person-to-person payments either, the P2P stuff.
No, they saw that trend clearly. They mentioned launching a real-time P2P solution, but interestingly, they did it collaboratively.
How so?
They partnered with 6 other major banks. By pooling resources and networks, their combined P2P service immediately covered something like 60% of all U.S. mobile banking consumers right at launch.
Smart. Using their scale as incumbents against the smallest startups.
Leverage the network effect. Why have dozens of competing bank P2P apps when you can create a dominant coalition?
Now, innovation wasn't just about new products for customers. It was also about using their internal data more effectively, right?
Absolutely. They highlighted their internal intelligence solutions group. Think of it as their own dedicated big data and analytics powerhouse, with over 200 data scientists and analysts even back in 2015.
And what kind of things were they doing? Any examples?
Yeah, they give a good one from their commercial banking division, using big data analysis for what they called responsible prospecting, meaning analyzing their vast internal data troves, transaction flows, client profiles, etc., to identify potential new commercial clients who are a really good fit for the bank. They claimed this approach uncovered and qualified twice as many high-quality prospects compared to their traditional methods.
So using data to make their sales efforts much more efficient and targeted.
Exactly. Turning raw data into actual business growth. And on the customer service side, too, like using data to power personalized offers on Chase.com, the always-on offers section, tailored to what you actually qualified for.
Right, using data to make the experience better and more relevant for the customer. So all this effort, the fortress building, the de-risking, the tech investment, ultimately, it has to translate into value for the shareholders. The letter made sure to connect those dots, didn't it?
Oh, definitely. They put their long-term performance right out there. They pointed out that since the current CEO had taken the helm back at Bank One in 2000, the stock had delivered a compounded annual gain of 10.2%.
10.2% per year. How did that compare to the market?
It crushed the market over that period. The S&P 500 index only returned 3.8% annually, and the S&P Financials Index did even worse, just 1.9% per year.
Wow. So the argument was clear. Our long-term strategy of stability and investment, even though it's expensive and complex, ultimately delivers superior returns.
That was the core message to shareholders. Stick with us. The Fortress strategy works in the long run.
Okay, let's shift gears now to the final section, Section 4. This part of the letter moved beyond just finance and operations, looking at risks like geopolitics, public policy, and also their people.
Right. Since they operate in over 100 countries, geopolitical risk is a constant reality. Their philosophy was interesting.
What was it?
Basically, commitment. They emphasized they're in countries for the long haul, not jumping in and out based on headlines or short-term volatility.
But how do they manage the risk then? if things go really bad in a country.
They stress test everything. They specifically mentioned modeling severe stress scenarios for key international exposures to make sure they could handle the potential losses.
Any specific examples they gave?
Yeah, they mentioned two big ones at the time. For China, they ran a scenario of a severe recession there and estimated their maximum potential loss at around $4 billion based on their $19 billion exposure. They felt that was entirely manageable.
Okay, and the other?
Brazil, which back in 2015 was going through a lot of economic and political turmoil. Again, they ran an extreme stress test and projected a maximum loss of about $2 billion on their $11 billion exposure there.
So the message was, we know these places can be volatile. We stay committed to our clients there, but we've modeled the worst case and we can handle it.
Precisely. Prepared resilience.
Now, moving from global risk to internal focus their employees. They talked quite a bit about employee wellness, didn't they?
They did, and with some significant numbers. They spent $1.1 billion just on U.S. medical benefits in that year alone.
$1 billion on healthcare for employees.
Yeah. And they highlighted their preventative care and wellness centers. Apparently, they had a high participation rate, 74% of employees using health assessments and screenings.
It sounds pretty successful.
And they even noted, interestingly, that their internal health and wellness centers had handled over 100 interventions in 2015 that were potentially life-saving, so showing a tangible human impact from that investment.
That's quite powerful. And they also addressed diversity and inclusion pretty directly, which you don't always see in these kinds of corporate letters.
No, it was quite candid. They specifically acknowledged that they had, and I quote, simply not met the standards when it came to attracting and retaining African-American talent.
Admitting a shortcoming like that is significant.
It is, and they backed it up by announcing a new initiative called Advancing Black Leaders, committing an extra $5 million specifically towards addressing that gap. It signaled they saw it as a serious systemic issue needing dedicated resources.
Okay. And finally, the letter wrapped up by identifying what they saw as perhaps the biggest long-term risk of all, and it wasn't credit risk or market risk.
No, it was bad public policy. They argued that flawed government policies posed a greater potential danger to long-term prosperity than the traditional financial risks banks manage daily.
That's a strong statement. How did they back that up?
They used some powerful historical examples, the stark contrast between post-WWII East and West Germany, showing how policy choices created vastly different outcomes.
Right, and a domestic example.
Domestically, they pointed straight at the failure of Fannie Mae and Freddie Mac, calling it a catastrophic failure of policy and governance that ended up costing U.S. taxpayers $189 billion.
So, learning from past policy failures, what were their current concerns back in 2015 regarding U.S. policy?
It wasn't about an immediate crisis brewing. It was more about a slow burn, the corrosive effect of the U.S. seemingly being unable to tackle big long-term structural problems.
Like what?
Things like persistent fiscal deficits, complexities and inefficiencies in the tax code, and the need for major education reform.
And their warning was?
That these kinds of policy failures often have a long fuse, maybe a 10-year lag. Yeah. So the problems being ignored or kicked down the road then would likely cause significant economic harm a decade later.
A sobering thought. Do they connect policy back to market functioning at all?
Yes, crucially. They circled back to the new regulations themselves. They expressed concern that some of the new capital and liquidity rules seem to be contributing to lower liquidity in markets, especially in fixed income, and potentially higher volatility.
Less liquid markets, more prone to sharp swings.
Right. And they stated pretty bluntly that they thought this dynamic lower liquidity, higher volatility was probably here to stay.
And this ties into that really critical point they made about the potential unintended consequences of the new safety rules.
Yeah.
The idea of them being pro-cyclical.
Exactly. That's probably one of the most important and potentially worrying insights in the whole letter.
Okay, let's define procyclical clearly for everyone listening, because this really gets to the heart of the post-crisis regulatory paradox. What does that mean?
Think of it like this. Procyclical rules amplify the existing economic cycle, both booms and busts. So when the economy's doing well, banks easily meet capital requirements, the rules feel loose, and lending flows freely, maybe even too freely.
Okay, that's the up cycle. What about the down cycle?
That's where the danger lies. When the economy turns down and banks start taking unexpected losses, their capital ratios fall. The very same rules designed for safety now force them to protect those ratios.
And how do they protect the ratios quickly?
The quickest way is often to shrink their balance sheet, meaning reduce lending, sell assets, pull back from markets.
So the rules forced them to cut back on credit precisely when businesses and consumers need it the most, potentially making the downturn worse.
That's the definition of procyclicality. The rules could inadvertently amplify the bust, just as they might have amplified the boom.
So the quest for ultimate bank safety might have created a system that's less resilient in providing credit during a crisis.
That's the central policy tension, yes. And the letter actually put a number on it. They estimated that if markets seized up, like in '08, the new rules could potentially force banks, system-wide, to reduce credit to clients by as much as 10%, just to stay compliant with capital rules.
Wow. A potential 10% credit crunch baked into the rules.
That was their concern.
Okay, so let's try to quickly summarize the key takeaways from this deep dive into the 2015 letter. We saw a bank defining safety through sheer resilience, building that huge $176 billion capital fortress.
A fortress that came at a massive running, cost $9 billion a year just for controls, and required huge operational shifts, like shedding $15 trillion in derivatives exposure, and, remarkably, cutting ties with over 140,000 clients for risk reasons.
And despite all that, the underlying message was one of continuous improvement, being transparent, fixing mistakes, and ultimately staying committed to clients and long-term stability.
Yeah, that need to earn trust every single day through consistency and owning up to errors really came through.
Which brings us back then to that final, really provocative thought raised by the letter's conclusions about procyclicality.
Right, the question it leaves you with.
If we face another severe market crisis, and the very rules designed to make banks impregnable actually incentivize them or even force them to pull back lending by maybe 10%, right when small businesses and households are gasping for air, how does society ensure that vital credit still gets to where it's needed most?
Yeah.
If the fortress banks have to retreat to protect themselves, who steps into the breach?
That's the big structural question, isn't it? Maximum safety for the institutions might come at the cost of liquidity for the economy when it's most vulnerable, something for all of us to think about.